Hello and welcome to Finance RM. In this lesson, we will talk about different investment instruments. Firstly, equity-based instruments. Equity-based investments represent ownership in a company, giving the investor a claim on the profits and sometimes voting rights in the company decisions. Common stocks or ordinary shares. These are units of ownership in a public or private company, and their rights typically include voting rights at shareholder meetings, dividends if declared, residual claim on assets after debts are paid during liquidation. The return sources are capital gains, selling shares at a higher price, dividends, which is periodic payouts from profits. The risk factors include market volatility, as prices can fluctuate daily based on earning reports, economic data, and sentiment. There's no guaranteed return. Dividends can be cut. A practical example includes buying 100 shares of a company X at $10 per share, an investment of $1,000. If the price rises to $15 and you sell, then gain $500 plus any dividends received. Preferred shares. These are hybrid between equity and debt, and their ownership but with fixed dividend priority over common stocks. It features no voting rights usually, dividends paid before common shareholders, and higher claim on assets than common shares if liquidated. The types are cumulative, missed dividends accumulate until paid, non-cumulative, which is missed dividends are lost permanently, and convertible, which can be converted into common shares under certain conditions. Equity ETFs, exchange traded funds. These are funds that hold baskets of stocks and trade on exchanges like a single stock, and their advantages include diversification across many companies, lower cost than actively managed funds, and liquidity as bought and sold like stocks. Next, moving on to debt-based instruments. Debt instruments are loans made by the investor to a borrower, corporate, government, or individual in exchange for interest income. One type includes bonds, which are fixed income securities issued by entities to raise capital. The types include government bonds, which are considered low risk, corporate bonds, which are higher yield but higher default risk, and municipal bonds issued by local governments, often with tax benefits. The key terms in it are the face value, which is the amount repaid at maturity, the coupon rate, which is fixed interest rate paid periodically, and yield to maturity, which is the total expected return if held to maturity. The risk considerations include the interest rate risk, prices fall when rates rise, the credit risk, the possibility of issuer default, and the credit risk, which is the possibility. Next, the treasury bills, which is the short-term government debt, which maturities up to 1 year, issued at a discount to face value, investor profit equals face value, take away purchase price. And the certificates of deposits, or CDs, are bank-issued, fixed-term and fixed-interest deposits, FDIC insured in the US, very low risk. And commercial paper, a short-term unsecured debt issued by corporations to fund working capital, typically issued at a discount, matures in under 270 days. Next, hybrid and alternative instruments. These combine elements of both equity and debt or fall outside the traditional markets. So, firstly, are convertible bonds, bonds that can be converted into a set number of shares, and their advantages include the downside protection of bonds and the upside of equities. Then, the real estate investment trusts, or REITs. These are companies that own and invest in income-producing real estate. They must pay out most income as dividends, and public REITs trade like stocks. Private REITs have lower liquidity. Commodities, physical goods like gold, oil, wheat, traded on commodity exchanges via future contracts, often used as inflation hedges or portfolio diversifiers. Derivatives, financial contracts whose value is derived from any underlying asset. And options, right but not obligation to buy, sell at a set price, obligation to buy or sell at a set price in the future. And the swaps include the exchange of cash flows as interest rate swaps, a high leverage potential, and a high gain or loss risk. Then, collective investment tools, as these pool funds from many investors to invest in diversified portfolios. This includes mutual funds, which are actively or passively managed, and they're priced once per day, NAV. Their fees is the expense ratio, and the possible loads such as sales or commissions. Hedge funds, which are private, high minimum investment funds, and use aggressive strategies such as short selling, leverage, and derivatives. and less regulated, high risk, high potential return. Private equity and venture capital, which is when private equity is when invests in mature and private companies for restructuring or growth. Venture capital, which invests in early stage high growth startups and illiquid but potentially very high returns. Lastly, index funds track specific indexes, let's say the S&P 500, and their low cost passive investment style, and they're suitable for long-term hands-off investing. Risk, return, and liquidity considerations. Every investment instrument must be evaluated on risk types, the market risk, price fluctuations from overall market movements, credit risk, borrower default possibility, liquidity risk, difficulty selling without the price drop, currency risk, FX rate changes affects returns on foreign investments, and inflation risk, purchasing power erosion. The return types include capital gains, which is price appreciation, income, including dividends, coupon interest, and rental income, and the total return, which is a combination of gains and income. Then we have liquidity spectrum, which is high liquidity, such as stocks, ETFs, and T-bills, medium liquidity, such as corporate bonds, REITs, and low liquidity, such as private equity, real estate, and collectibles. Then we lastly have the diversification strategy, which is spreading investments across asset classes to reduce unsystematic risk, and correlation matters as they aim for assets that do not move in sync. Also, you should always try and be careful of how much things they provide and companies on what returns they will give. Always be careful financially and be safe, and always evaluate a company using methods as we have mentioned before, and look at the market risk, the credit risk, the liquidity risk, inflation risk, currency risk, interest rate risk, reinvestment risk, and political regulatory risk such as changes in laws, taxes, or government stability impact returns, and concentration risk, which is overexposure to one asset, sector, or region, which can increase the vulnerability. Always diversify your portfolio and focus on its allocation and spread it across asset classes such as stocks, bonds, cash, and alternatives. And keep the time horizon and liquidity planning, as well as risk management techniques such as stop loss orders to limit downside, hedging through options and futures, and rebalancing portfolio periodically to maintain target allocation. Thank you, and don't forget to drop a like and subscribe to the video. Please comment any questions you have or advice you have for the channel. Don't forget to be smart, stay smart, and achieve your financial goals.